Wir haben hier zu Gast David Millar von Invesco Asset Management. David Millar ist der Fondsmanager des Invesco Global Targeted Return Fund. David, thank you for being with us. In December 2013, you launched the Global Targeted Return Fund, which now manages over 10 billion in a time frame of 2 years only. Sounds like a good success. Are you happy with the fund?
I think we have to be happy with that type of asset growth over such a short period of time. Now that's 10 billion across the different types of the funds, so the UK fund, the Luxembourg fund, and so the US mutual fund as well. But the total growth in the strategy has been over 10 billion. I think it's a reflection of the growing amount of interest in multi-asset funds overall, both for retail investors and institutional investors. Has definitely seen an increase in the allocation that people are prepared to make to the multi-asset sector.
And now there is another sister fund, so to say, the Global Targeted Return Select Fund. What is behind that idea, that concept?
The concept behind the Select Fund is that there's a group of investors who aren't able to invest in the Global Target Returns Funds because of some local regulation, and while not wanting to compromise the unconstrained research philosophy of the fund, we did think we'd be able to put in a couple of restrictions in order to allow the fund, for example, to be VAG compliant for the German institutional market.
VAG compliant, how do you implement these restrictions that VAG asks you?
The main implementation difference is the inability to hold non-investment grade bonds, so CCC bonds and below. So where investing in credit, we have to ensure that the Select Fund keeps within that requirement, whereas the regular fund doesn't have that restriction. But it's really pretty much that bond restriction was the main requirement to make the fund be VAG compliant. But in terms of the 25 different investment ideas that we have in both those portfolios, we're really just talking about a small part of one of those investment ideas that's affected by that.
Are there other restrictions that the fund has to obey?
The other restriction we put into the Select Fund was to say it wouldn't hold soft commodities, so no agricultural commodities. So that's part of an SRI screen, which again is to satisfy some other regulatory constraints. And there's a small differentiation in terms of the proportion that can be held in underlying funds, again to satisfy some regulatory restrictions. So all of these are important in terms of satisfying the local regulators concerned, but we believe that by putting those restrictions in place wouldn't compromise the ability to implement the investment ideas at all. And so the target performance for the fund and the target volatility for the fund are exactly the same as for the other fund, but we just have these sort of restrictions in place to make sure that we don't cross the line, so to speak, for any of those particular regulators.
2016 was a difficult beginning of the year, but it seems that the fund has done a small but positive performance in that time, different to other asset managers, to other funds. Where do you see the advantages, and how did you achieve that positive return?
It's all about the individual ideas and making sure that you have ideas in the portfolio that, while they will deliver a positive return in our sort of cautiously optimistic view of the world, there are ideas that are in place that specifically work even better in market downdrafts. So there will be some investment ideas, like our equity ideas, which will have suffered in the first 2 months of the year, but there are other investment ideas which will have done particularly well. And on balance, those ones have outweighed the bad ones and allowed us to have a small positive so far.
Can you give us 2 or 3 examples of good ideas and perhaps those who turned bad in the beginning of this year?
I think but the bad ones are obvious. The bad ones are, credit has had a very difficult start to the year. The equity ideas have had a very difficult start to the idea. But some of the ideas that have done very well are things that you might not expect, but something like being long US staples and short US discretionary. It's a bond idea, really. I mean, it has bond-like characteristics in that it performs when markets are difficult, and something like that has worked very well so far. The bond ideas like the compression of Australian interest rates on European interest rates, Swedish interest rates have compressed on European interest rates. So there have been a number of sort of bond ideas, or the bond proxies like staples versus discretionary, also having ideas which have long volatility, because clearly markets are more volatile. And so as volatility picked up, some of these ideas that have expressions of volatility in them have done very well as well.
There are some tactical asset allocation concepts behind many multi-asset funds. Is that the same for your fund? Do you implement some tactical asset allocation concepts into the fund?
No, we tend to keep things on a strategic basis. The idea is that if we have 20 to 30 individual investment ideas, each of which we believe will deliver a positive return on a 2 to 3 year view, then as we go through that 2 to 3 year period, some of them will pay off at some times, some others will pay off at other times. But as long as we believe that all of them will pay off on that 2 to 3 year view, then we'll get the ultimate end point. But there'll be 2/3 of them working and 1/3 of them not working along the way. So it tends to be more strategic, trying to find opportunities on a 2 to 3 year view, but trying to have enough of a different range of opportunities that you have the different balances in the portfolio while you go through the difficult periods, rather than sort of adjusting it on a tactical basis as other funds may do.
So let's perhaps meet in 3 years and look back into the performance of the fund. Good luck, and thank you that you were here with us. Thanks.